Welcome back to Beat Up Exchange number 20. A huge milestone for the fellas, and we are excited to bring you an episode.
It's been a long time coming, man. Good stuff. Good stuff. We got a fun one here today.
We do indeed. And in the spirit of James, just getting right into it. Electronic Arts, better known as EA, got LBO'd by Jared Kushner's affinity partners, by Silver Lake, and the Saudi Sovereign Wealth Fund at a record price, $55 billion, the biggest ever. Wow.
Wow. Yeah. Biggest LBO ever. I think it beat out a 2007 LBO. The Saudi Sovereign Wealth Fund is pledging $36 billion of this $55 billion LBO. Yeah, this is a lot to unpack. This is a big, probably the biggest thing happening this past week. Video game makers in general have kind of been sliding since the pandemic boom. So, EA had a day earlier this year where their stock price fell 17% after some poor FIFA sales. So, looking to, I don't know, go private, rework their strategy, find a new direction.
Right. And I think thinking about like 2007, and I think the biggest bail before us was a company called TXU that did boring stuff, energy, but over $30 billion transaction. Whereas something like this is, I see this as having more inherent risk factor there, that in an oil business that you're selling something that is a pure commodity, whereas in gaming, people can like your stuff and then they can hop over to Fortnite and hop back. So there's definitely more risk there. And at least my understanding of how EA works is that you have to go to the store and buy college football, NHL, or even on like the software, you have to like pay a price for them. Whereas some games like Fortnite, just to keep using that example, you just buy with the in-store transaction. So I wonder if their business model is all coming under threat, but I don't know. One concern I have.
Yeah, I mean, for me as a video game player, at least back in the day, it's annoying to have to buy the new version every year, and there's not really a huge improvement to the actual game itself. So that is a risk, and seems like they're bullish on EA, though. We'll see what happens. But another big story coming out here is I've been reading a lot of people, who are a little skeptical about the Saudi Sovereign Wealth Fund, their public investment fund, having so many stakes in major U.S. companies. We've seen them try to break into golf with the Live Golf League. They have shares in another U.S. tech company, Lucid Motors, big in the real estate, U.S. real estate, related companies, Rocco Fort Hotels Group. So, I don't know. Are you skeptical of how Saudi is involved in U.S. affairs, or do you think that this is nothing to be worried about?
I'm a little skeptical just because of what I think that they're trying to do from a reputation perspective. Because when I think of Saudi Arabia, and I think when most people thought of Saudi Arabia, at least 10 years ago, you still thought of excess, and you have huge wealth inequality, and you have human rights violations. You have women who don't have the same rights as men from a legal standpoint, don't have the same privileges to pick who they marry. It's just a very regressive country. But you're able to kind of distract from that when you invest in sports businesses and you're hosting the World Cup in a few years, and you're able to kind of reinvent yourself in that way. And I think that it almost helps divert people's attention from some of the fundamental problems that they do have. So I think that is one place where I might worry.
Fair enough. Yeah, I guess my perspective, I don't know how skeptical I am. I think it's more, trying to get involved in some big American companies and finding a way to, grow a business. We've even seen their soccer league attracting, Ronaldo and other stars to their soccer league. I can't tell you what the name of their league is, and I'm not sure how the ratings look, but definitely some Ronaldo jersey sales, and they're trying to establish a better presence in the world, and maybe this is their method of going about it.
And I think the other thing that's notable here too that I thought was bizarre is why in the world Jared Kushner's in this deal at all. And notably, his biggest investor is already the Saudi Public Investment Fund by a large margin, which I just found via Wikipedia. And so I think really the only reason why he's in the deal is to make Trump happy. And I think that is something that's also just a little bit bizarre that you're bringing this person along just because you know that. I don't know if it has a practical reason in terms of regulatory approval, or it's you just trying to split some of the profits over to a family that you know has direct ties to U.S. leadership. So worth noting, and just keeping your eye on making sure that the proper checks and balances are in place in terms of what's getting allowed and what's not.
Yep. And the third investor was Silver Lake, right?
And I would guess that they're probably going to be doing most operations on this deal because they are one of the people who are the big player in that space, in tech, and particularly people who do more things with the sports, media, telecom. So I would hope that their expertise comes into play here.
I'm sure it will. But that's a huge thing that's going on. You also wanted to touch a little bit on what's happening in the real estate market. Back to kind of our roots.
That's right.
So Trepp came out recently and said that, the CMBS delinquency rate decreased for the first time since February. It's now down to 7.23%. Still extremely elevated from pre-pandemic levels that were sitting under 3%, but maybe a step in the right direction. And we've also got a rate cut that just came in, and hopefully another 2 in the next, before the end of the year. Could be a lot of optimism in the real estate space right now.
Right, and I think that this is a good sign of tracking delinquency, and to see that it's ticking down. But thinking about issuance too on the CMBS side is also important, and we've seen issuance really climb back up and making good pace this year in terms of the new volume of loans that are being issued. We saw a big securitization happen a couple weeks ago with Blackstone and Starwood doing $2 billion on extended stay hotels, which normally is something that could be more difficult to finance. So we're seeing a lot of deals getting done and a lot of optimism on the credit front. I think one thing that this rally is missing is more LP equity needed to get some of these deals to the finish line, and there are kind of more creative ways to get around that. Especially just because we're seeing record returns in the stock market, and you can get great returns in other places in credit. So why would these LPs come to real estate? But they're still finding ways to figure it out, and I think that having more good news on the credit front here is helpful.
Definitely, yeah. Finding other, as just kind of build off what you were saying, where this is assumable debt or preferred equity, mezz debt. Just getting creative with your solutions, and if this can buy the real estate space a little bit more time before more rate cuts come in, it's just overall it seems like it's improving market sentiment here, and could expect some better days for real estate coming up.
Right, and I think that we can maybe get in this AY article too that gave kind of a good overview of what might happen with rate cuts and what it just means as far as sentiment's concerned. And one thing that we talked about earlier is that hopefully that this is a time when transaction volume starts to pick up, that we've seen coming from a high rate environment to a low rate environment. Hopefully that starts to make cap rates compress a little bit and people feel better about selling. People who had gone out and extended their loans because they didn't want to refinance into an environment that was much higher interest rate that was going to hurt the value of their property. Hopefully they can see the benefit of sticking it out and waiting now, but there probably still is more room needed to cut for it to make a meaningful difference.
Absolutely, yeah. That's kind of the theme here from the article. It's just a step in the right direction if it can boost consumer sentiment. They even mentioned this a lot in the retail space, that if you have a rate cut, that can work its way to the consumer and hopefully ease some stress there. And what you were saying before about sales volume, you look at something like multifamily, sales volume is down around 34% since 2022. So really lack of deal making going on there, but the fundamentals are pretty strong, good absorption. So you look at an asset class like that, could be really primed for some growth in terms of valuations.
Right, absolutely, and hopefully right in time for Christmas shopping and getting some more sales growth in there too. Hopefully that's helpful as well. And also, I think good news for the consumer, but bad news for rate cuts is this I saw in just a chart book from Apollo, but I thought some of the data in here was interesting as far as indicators. You might appreciate some of these. Daily TSA data for the number of people traveling on airplanes is still strong. Data for number of people going to Broadway shows, the movies, and visiting the Statue of Liberty is still strong. Statue of Liberty, economic indicator. Okay. Same store retail sales is strong. Data for bank lending is accelerating. Bankruptcy filings are starting to trend lower. Business formation is still strong. So those are all good things that show the sign of that the economy looks healthier than maybe it did a few months ago than when we were looking at it. But also means that maybe there are still upside risks to inflation if you continue to cut, which would be harsher for CRE. So kind of weighing those two things as we move more into the fall.
Yeah, I mean, I like where you brought those stats from, but I feel like whenever you read like the consumer confidence, graphs, it's always low, 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 but the spending's still high. So I like how, the consumer could say whatever they want, but they're still spending right now. So good sign of what's happening.
Right. And we had I think we had a chart on development too, if I'm not mistaken, and that's continued to decline. I think that this is partially impacted by what the costs of construction are now, and I think the tariffs have been particularly harsh in that area. I think things like steel, things like glass, to some of our big trading partners in Canada and Mexico who are facing tariffs, which are where we source a lot of these supplies. I think that's something that has hurt, but I think it's also something that's helpful for some of these oversupplied real estate markets and making sure that they can contract and have the proper absorption to get rents to where they need to be for supply to kind of continue to grow at a more mellow pace without the massive swings.
Yeah. As long as, I think the thing that was really plaguing the market for some time was just overall uncertainty, and then you can't borrow, you can't make projections for the future because you just don't know what the economy is going to look like. So as we are having a little bit of a clearer picture of what's to come, it's just going to make investment a lot easier and be able to fund more projects, more development, hopefully. And, again, optimistic, but this delinquency number still is at a very high historic rate. And, it's by no means done, but, again, just moving in the right direction.
Absolutely. And I think that on the supply side, I'm not sure where I saw this graph, but I'd be curious of how much today of that is data centers and how much of that is not, because I know data centers are at a super high clip year on year in terms of the amount that's being developed. And I have to imagine if you're one of the people who is an engineer in one of these cooling facilities that they can't find enough people like you, or they can't find enough people who are skilled at building these things. But I think development is down in almost every other property type. So whatever overall development numbers you see, just know that they might be skewed by we have that one anomaly right now.
Yeah, the ones who are killing it. But maybe this is a good time to jump onto our next article, piece from Trump's new appointee to the Fed board, Steve Miron.
Yeah, I can maybe kick this one off. I know I added this. He has a great first sentence. I love a concise topic sentence. The deep unhappiness with the prevailing economic order is rooted in persistent overvaluation of the dollar and asymmetric trade conditions. Such overvaluation makes U.S. imports less competitive, U.S. imports cheaper, and handicaps American manufacturing. So what he goes back to is he talks about cities in the Rust Belt, cities in the Midwest. My family comes from auto towns, and I have seen firsthand that a lot of those have been really hollowed out. And those, not only those manufacturing jobs go away, but the whole kind of city goes away, which is tough. And I think that what Moran is pointing to is that part of the reason for this imbalance is you have in certain countries, you have exports that are bigger than imports, so they're running a trade surplus, which means that we in the U.S. we import their currency because they're paying for. I'm getting confused here. Hold on, you take it for a minute. Let me read.
Yeah. So I mean, basically, the point is, as the world's reserve currency, the U.S., there's always a demand for the U.S. dollar. So the U.S. dollar's value has been inflated over the years. Maybe not inflated, but as he uses the term, overvalued. So makes importing a lot cheaper, but it makes exporting a tough job. So as you were saying, manufacturing declines, but as you were saying with trade, we end up having a trade deficit because we are importing than we're exporting, and this leads to a decline over time. And as you were saying, these manufacturing cities are manufacturing plants. I believe that from 2000 to 2011, there were somewhere between 600,000 and a million U.S. jobs for manufacturing that disappeared. So this is a huge chunk of jobs, and this is kind of Miran's opening to what he's going to go further into. Maybe if you want to jump back in. This is a hefty topic.
Yeah, this one's a little bit tough, but the I think the mechanism on the trade front is that you have countries that are exporters that are exporting more than they're importing, and in a perfect world, like this ends up with a trade balance that it ends up that your currencies match up because whoever is paying for these goods, you're paying with your native currency, and the people who get those goods, say in the U.S., they're exchanging it for U.S. dollars, so the U.S. dollar appreciates until you end up with a balance that it's no longer advantageous to do so. But the problem with the U.S. is because it's a reserve asset and because it's so ubiquitous worldwide is because the dollar is appreciating to a level to what you said makes it really hard to export competitively. So that's a problem in his framework. And apparently it only gets worse over time because global GDP is growing faster than U.S. GDP is growing. So that's a constraint here. And what that means is we have to continue to supply all these risk-free assets, all these goods that end up worsening the problem. And especially if you get into a situation where the economy goes into a sharp sort of decline, that leads to everybody goes in and rushes his risk-free assets, and the currency appreciates even more, which hurts your manufacturing even more. So it kind of worsens the severity and depressions on your manufacturing arm. So that is a problem. I think that there are things that this theory leaves out that are important too. But I think that this is more credibility than I would have thought, or more logical soundness, I think, than I would have thought.
Yeah. I mean, I thought this was a really interesting piece, and especially as he mentions during recessions when everyone floods to U.S. currency, it makes the problem even greater. And this is something that Trump has come in and he's taken a little bit of a unilateral approach, trying to implement tariffs and issue subsidies for industries and that are going to pledge investment into U.S. manufacturing. So that's the angle that he's coming into, and this is fast. You have full control over it, but there's a lot of volatility, of course, that we saw earlier this year, maybe in March, April, when the markets were really taking a hit. And on the other side of it, you have multilateral solutions. So this is working with other countries a little bit closer to reduce trade barriers, adjust tariffs. This could be lower volatility, but it's a heck of a lot harder. So this is a really, really tough issue, and I think it's just interesting to see the route that Trump's taking, especially from a national security perspective, the importance of having manufacturing in-house, especially as other world superpowers grow in strength, as we'll talk about more, China, Russia as well. So that's kind of where I'm seeing right now.
Right. And I think that what this article does well, too, is point out that trade-off in between. And he mentions that there are cheaper borrowing costs associated with having the U.S. as a reserve asset. Obviously, because we know like when everybody wants to hold these dollars elsewhere, that makes it cheaper for the U.S. But he's somewhat skeptical of that too, because he said that every other G7 country besides the United States borrows at a cheaper rate than the United States right now, and they don't have nearly the volume of debt that the U.S. has, which he didn't necessarily say, but that is important too. And also, people using dollars allows the U.S. to have a hand in these regulatory matters. It allows the U.S. to freeze assets, track transactions, use SWIFT to impose sanctions on Russia, like we saw in 2022. And we know that it didn't exactly work the way we wanted to, and they were able to just dump all their oil on India. But there is a path to have some sort of outsized influence because you have the currency. So I think that's important as well. So I think that this theory has some credibility. So I think that we should keep it in mind, and keep in mind that there is a trade-off between some of these things that with having a strong dollar.
Yeah, it's a tough dilemma, and the Triffin dilemma is what it's called. But something that I thought was interesting to note is just that Trump still wants the U.S. to be the reserve currency. I remember when tariffs were kind of first coming out and the dollar was really sliding, a lot of people were theorizing that Trump wants the dollar to decline. He wants more manufacturing and more exports from the U.S. And while he might still want that, it's clear that he still wants the U.S. dollar to be the reserve currency, as you noted, lower cost of borrowing. And he's even threatened to punish some countries that are looking to move away from it. So it's like, can you have both? I don't know.
I don't think so. I don't think so. I think by its very nature, and I think part of it's tied into other factors, but I think one of the reasons why U.S. dollars are good collateral is because people trust that their value is going to stay pretty much similar. And if we have a lot of variation in exchange rates with the dollar, I think that has to, I think, take away from its reserve currency status. But I wanted to bring up this quote that I loved from the guy. Treasuries bought to collateralize trade between Micronesia and Polynesia are bought irrespective of the U.S. trade balance with either the latest jobs report or the relative return of treasuries versus German bunds. So what he's saying there is that no matter what happens to the valuation of dollars in terms of the manufacturing trade and how much we're buying Chinese goods, how much the Chinese is buying U.S. steel, while those might balance out to an exchange rate, whatever that exchange rate is going to be totally morphed by Micronesian T-shirt makers who are sending their goods overseas and want to hold collateral on those receivables. So that's important too. I think that just a good quote to drill it home.
Yeah, thank you for translating that. That's a tough one to unpack, but yeah, Micronesia holding the reserves. Yeah, I mean, summary, I think it's pretty great to be the world's reserve currency, but that does come with trade-offs, and Trump's looking to bring a little bit more national security as global powers arise. Maybe that's a good time to jump into this next little political piece if you want to open.
Been a while since a good segue.
We need that.
This theory is a lot simpler. Article's a lot shorter. This is an article from a guy called John Mearsheimer, who still works at the University of Chicago, I believe. He has a simple theory about how the world works, often disputed with much more complex theories, but his is simple, that the world is anarchic, that there is, if you are a country in the international system, there's no 911 to call if you get in trouble. You're on your own, and you have to rely on your brute force. And this also comes with the assumption that all great powers have some ability to play offense, that the U.S. has an ability to, has a credible threat to be able to take over Canada or attack some of these other countries. And in this system, it is better, I thought that this was a great line too, in the world of in the anarchic world of international politics, it is better to be Godzilla than Bambi. You want to be the big dog. You don't want to be the little pup. And what you want is also to be a regional hegemon, to be the person in your side of the hemisphere, your side of the globe who is dominant. And if you think about the U.S.'s situation, You have Canada above you, who's a lot weaker militarily. You have Mexico below you, same thing. And then you have fish to your east and fish to your west. So you're fine in that respect. But you also don't want other people to be regional hegemon. And that's where the China thing comes into play, that you have China who's rising, who is exerting more and more influence on the Koreas, on Japan, on Taiwan potentially, which he sees as a possible pendulum here. And there's a nasty competition that's going to take place because China is rising because of all the things that we've talked about, and not to mention the fertility story that we had, that they're a country that is growing in population while the U.S. is not. So these things are going to come to a head. And Mearsheimer, I think in the article, talked about that he advocated for preemptive war in the 2000s, that because, China's going to rise, why not attack them now? And that didn't get a lot of traction for obvious reasons. But it is kind of interesting that today, fast forward 20 years, we still kind of have the angle that it almost feels like we're looking for anything to be upset with China and for a reason to go to war or stymie their growth. The Obama administration talked about containment a lot, and that's been very clear from Democrats to Republicans that China is a threat.
Yeah, I mean, when you're saying that, I mean, I just think of Korean War, Vietnam War. I think about containment back in when the Soviet Union was rising, like 60s. I think this is a great theory. Maybe not the idea that we should go to war. We should have went to war with China to kind of try and limit their growth early on. But I think that the message still holds true, and we want to establish ourselves and limit power. And we talked about, however many weeks ago, NVIDIA convincing Trump to have China buy the H2O chips from us, so becoming dependent on us in that way. China's also dependent on our currency, as we have spoke about before with MMT, and sort of being able to create money out of thin air to purchase their products. So China's still very reliant on us, but they have been growing their military, of course, and they've been doing a lot of very incredible things technologically. Of course, we saw DeepSeek. So, I don't know. Where do you think you go from here? What do you take away from this article if you were a person in politics? What's your move here?
Well, his answer is that this is the tragedy of great power politics, and there's absolutely no out to this. That this is the end game, which is sad, and hopefully not the case. But what I take out of this, I think what I take out of this is someone who talks about markets primarily, is that whenever I read anything from the White House or from the Chinese that say, if we get this one issue fixed, whether it is, I don't know, fentanyl, or whether you guys fix your abuse of Muslims in the southern part of the country, I don't think that there's anything that will fix this relationship besides that China needs to be less powerful, that this is fundamentally about power. And China could be a mirror image of the U.S., and this U.S. wouldn't like that U.S. because that U.S. is growing in power. So I think that's important from just when you read the headlines, or at least that would be my view.
Yeah, it's not like there's going to be one solution. Oh, if we get, if we lower tariffs, we're going to all be happy. Or if we all, as you said, fentanyl. This is going to persist, and, hopefully we can limit tensions for some time. I don't know if I don't know. This is a tough one. But like you said, good question.
How would you feel about if someone said economic integration is the way out of this, that we need more trade with China, we need more entanglement with China on trade, we need to do more business with them in order so that they don't attack us, that we neutralize the security threat, have more maybe cultural flows overseas, that if there are more McDonald's in China, that maybe they won't see us as much of a threat because they get all our culture and entertainment. Is that a credible argument to you?
I do think so. I think from a cultural perspective, seeing each other as one. I mean, this is kind of more of a philosophical argument that I'm making here, but I think that when a nation maybe demonizes another country and only promotes their national products, you kind of begin to have a sour taste to anything else. So I think that could work. I mean, it makes me think of the tariffs on movies that Trump is putting into place now. That's a pretty interesting one, but I think it could work decently well. But there also is the question that as the states just grow larger and larger and more powerful, if there is some sort of conflict that arises, do you just shut down those ports instantly? And then, let's say the U.S. is only getting its, I don't know, pharmaceuticals from China, and there's a dispute, then the U.S. becomes, complete, like China has the complete leverage there. So you just kind of wonder how that's going to play out, and keep coming back to this. That's a mission of the Trump campaign right now, to bring manufacturing in the States so you don't have to do that. So there's definitely a balance between it, and I'm not sure how it would be perfect, but I don't know.
I like that. I think the only hang up I get with it is I feel that we were in that economic integration period pre-Trump for a solid 20-25 years, and now here we are where we are deintegrating. And that seems mostly driven from U.S. jealousy, U.S. wanting to maintain, like back to the Mearsheimer thing, want to maintain power fundamentally, and that there is a sense of insecurity about what it means to live in a world where China is the most powerful state, that I think a lot of people in the U.S. will not let go of, because I think it's almost indisputable to me that it seems like China, from a labor force perspective, from an infrastructure perspective, seems like that they are just growing at a faster pace than the U.S. is. And the U.S. seems to not want to accept that, for better or worse. And I think that they're certainly that's certainly understandable perspective to me. And I think that integration is the best solution and the best mutual beneficial option. But is it one that is politically tenable to the people of the U.S. to say, okay, we're going to live in this world and know that China's stronger than us militarily and we don't have our own security at hand? I don't know that would sit well with a lot of people.
Tragedy of great power politics. That's what it comes down to. Good way to summarize that. Maybe we could jump into our last little article now on that note.
Hopeful article. That's what we try and do.
Yeah. Maybe another doomsday article. We got another sort of.
I'll pull out a hopeful
sure.
strand. You
Sure.
go first.
Sure. Article from the Financial Times, Ian Harnett, saying that the AI bubble looks to be approaching its endgame. The dramatic rise in AI capex by so-called hyperscalers of the tech and stock concentration U.S. equities are classic peak bubble signals. So, not a great way to jump into it, but as we talked about before, he's highlighting the massive capex spending and then kind of comparing it to previous bubbles of the past, particularly .com bubble. A lot of capex spending there, and similarly, kind of the point that he makes are kind of just how the equity investors are going to take a hit from this. It's not on a debt side, so there's a different policy response that comes in if this is a bubble, but I guess maybe that's the first part we get into. He seems to be sold that this is a bubble. There is no ifs, ands, or buts about it. He is just, this is a bubble. This is what's going to happen. This is what we should do. So
yeah, that rhetoric seems like it's everywhere, and that is actually a great point that you bring up, because for how ubiquitous that perspective is, I'm shocked that it's not reflected in some of the stock prices, because the stock prices have not moved and just continue to go up. But he says some things that are interesting about that these companies are doing deals between each other, and I've seen memes on those that's something that happens. As just a way to prop up the stock price. But he does have a somewhat hopeful note that because of all this investment infrastructure and things that wouldn't have been able to build without this cost of capital being as cheap as it is today. That's allowing for all this infrastructure to take place for whatever comes next. Because it's always interesting to me of how we think about the dot-com boom, and we had all these dot-com companies, and we almost talk about it like, the dot-com is a fluke, that the internet, was a total nothing burger, and I'm on the internet every waking hour of the day. So clearly there is something there, and I think that there's some there with AI too. Like the things that ChatGPT and Copilot can do are absolutely insane. So I do get the skepticism as well, and I think that this totally could be a bubble from a market perspective, but from an impact perspective, I think that there's definitely going to be some application to this tech.
Yeah, if the bubble bursts, there's going to be sort of a rapid selling of some capacity, and I guess it's going to be purchased at a discount, and I kind of want to pass it to you. Like, we always talk about like Blackstone coming in and buying when there's economic troubles. Do you think someone like them, some of these large private equity funds, are going to come in and purchase all this capacity at a low price and then capitalize on it, and kind of they're going to be the ones in control of AI moving forward? Because I think the AI is going to stay. It's not a question of whether AI is going to be this great thing. AI is going to be here, as was the internet. But if valuations are too high and there's a bust, do you think that these major private equity firms are going to come in and take over for the equity investors?
We will see. I would be worried that some of these private equity firms that are jumping in late, and we're hearing about deals that are happening in the $40 billion range and up for data centers, which is incredible. That if you're getting in maybe on the tail end of this, that I think that your risk reward spectrum looks a lot different than if you were Blackstone buying QTS in 2021 for $10 billion, and now it's probably a $100 billion company, and you have a 10x multiple. That's a floor that you're sitting under on the rest of your investments. But we'll see who's left standing after all this, because I think if some of these firms that were jumping in late, and they're going to have to realize massive losses and return less distributions, and it's going to hurt their fundraising. So we'll see if anybody's going to cut them a check to be the vulture buyer on these data centers, or who's wiped out from the pack. I think that's something that I'm going to be looking for, of who's going to have the money on the other side of this, because there's a lot of people saying the S&P 500 is going to crash, but there are also a lot of people like myself who are still all in on the S&P 500. So who's going to be on the other side of that trade when this stuff goes down? Who knows?
Who knows? Maybe the U.S. government jumps in more, as we've seen so far. We'll totally see. Hopefully this doesn't happen in the same capacity, but I don't know. Also, something I thought was worth noting is that share buybacks are extremely high right now, which is driving up earnings per share. And if there is a crash, obviously this is not going to be great for these companies. And we talk about the corporate tax rate a lot. So, maybe that's a factor that's causing all these buybacks and less actually being put towards investment. So, I don't know. These equity investors, these big companies might take a huge hit here, and someone's going to need to fill the gap if it happens. I don't know if I'm sold on this bubble yet, though.
We'll see. Regardless, it seems like all these data centers are going to get built, bubble or not. So we'll have some very shiny buildings at the end of this, good or bad.
Yep. That's how it's going to be.
All right, wrap it up there.
Yep.
Episode 20 in the books. Thank you all very much for tuning in with us. We always really appreciate the chance to share some of the things that we've been learning about with you all.
Yeah, always a pleasure. Have a good week, everyone.
Thank you.